If you live in Europe and you've got a question about investing, chances are that question is answered in this video. Over the 18 years of my professional experience, including as CEO of a European investment company, I've seen pretty much all the major questions for European investors. For this video, my email readers and followers sent in hundreds of questions and my team selected the top ones. I've never seen these questions before. I'm just going to answer them off the top of my head, and we will put timestamps down below for easy access. What would you do if you had 5,000 euros available for investing right now as a young man in his 20s? Okay, so I would put some money aside in high-yield savings account as my safety cushion to make sure that if I lose my job or have some other issue, that's taken care of. And then I would buy a diversified, low-cost ETF to invest in the stock market. But beyond that, I would really focus on figuring out how can I supercharge my career, how can I make more money while keeping my expenses low. Because the 5,000 euros I invest today, honestly, even compounded over my lifetime, not going to make a big difference. What is going to make a huge difference for my future is if I put in that 5,000 now, and then every month for the next 20, 30, 40 years, I put in 200, 300, 400 more. And that's going to make a huge difference for my future wealth. All right, best cheap stocks that pay dividends. This simple question actually has multiple issues with it. First of all, why are you trying to pick individual stocks? Professor Henrik Bessenbider looked at the American stock market. Over the past 90 years, there were 26,000 different stocks in the market. 11% of them went to zero. They cost investors everything. Half of all stocks lost investors at least a bit of money. Okay, the typical stock in the market was a loser. So if you try to pick individual stocks, it's a really, really difficult game, especially for amateur investors. Now, you could ask about dividend funds, for example, dividend ETFs or index funds, which invest in hundreds of different stocks that pay dividends. Now, that is more doable. But even there, you should ask yourself, is picking dividend funds really the best way to invest? In most European countries, if you get dividends in your account, you immediately have to pay tax. It's actually in your interest to buy so-called accumulating funds which don't pay out dividends. With these funds, the value of your investment grows over time and you only pay tax in the future when you sell the investment. And that makes dividend funds a lot less attractive. A lot of beginning investors think they need dividend stocks and dividend ETFs for passive income so that you've got cash coming in. But the reality is it's very easy to get passive income by selling stocks or selling ETFs or index funds when you need the money. And this gives you a much wider choice of investments. You don't have to look for dividend stocks, which aren't always the best investment. Now, if you really want to invest in dividend ETFs, you can go to justetf.com, which is a great database, which shows the ETFs available to European investors. You can click here on equity, which means stocks. And under equity strategy, you can select the dividend. Okay, so these are funds which focus on dividend paying stocks. What happens with your investments when you move countries? This is actually a great question because I run this training program called the Index Masterclass, and around half of our members are expats, and they're always asking, okay, I live in Germany, but now I'm moving to Switzerland. What should I do with my portfolio? Or I'm originally from Japan, but I live in Austria. Like, how do I pay taxes on my investments? And the good news is it's totally doable. Like, it's not a reason to be afraid of investing just because you're moving from country to country. It doesn't really mean there's any problem with you investing, but it does mean that you need to do a bit of work before you make the move. Okay, so what you need to consider is what are the tax rules in your current country? What are the tax rules in your new country? And how do these rules work together? Okay, there's often a tax treaty between countries that you need to take into account. The first thing you always need to figure out is when do I stop being a tax resident in the first country and become a tax resident in the second country? Okay, so that means I switch from paying taxes here to paying taxes there. Then I need to figure out when I leave this country, do I need to pay any exit taxes as I'm leaving? And then I have to ask, in my new country, what are the taxes I will have to pay on my old investments, which I made back in the old country? Okay, so there's a bit of nuance. There's some things you have to research. This is all I teach my students. And if you're interested, by the way, there's a link in the description where you can find out more about that. But my basic message is don't be afraid of investing just because you're going to be moving countries. Simply get ready to do a bit of research before you move. For someone in their mid-30s looking to build wealth for retirement and possibly retire early, what should we focus on to identify the right ETFs or index funds? So if you've got a lot of financial ambition, like retiring early, building up quite a bit of wealth, then, well, first of all, you will probably want to look primarily at stock investing. Okay, so this is higher risk, but higher reward. Long term, it's basically the only game in town if you want to build up enough wealth to retire early. And then actually the main focus of your time and effort should be to make as much money as possible and to save as much as possible. This will make a bigger impact than choosing an optimal ETF. Choosing a good ETF for investing, it comes down to, okay, pick an ETF that is diversified. It invests in many different regions, different industries, different countries, and make sure it has low costs. There are some technical optimizations around the edges to get the most out of it and to optimize your taxes and all that. But as long as you keep costs low and you're diversified and you're investing a lot of money every month, then you'll do great. Investing is all about the future. How do we invest sustainably without compromising the future? How do we invest ethically, okay? Well, there's good news and bad news, and then good news. The good news is that there are plenty of so-called socially responsible investing funds available. They go by acronyms SRI, socially responsible investing, or ESG, environmental, social, and governance. If you go on a platform like Just ETF and you select and you go down to sustainability and you click on only sustainable ETFs, you have like 769 funds to choose from. So that's nice. Now, the bad news is that many of these funds are basically doing just like greenwashing. They put a label on that makes them sound sustainable, but they're maybe not that sustainable. And also, everybody's definition of what sustainable is different. So your opinion of what is ethical and moral and correct may be different from the fund provider. So that's the bad news. It's not so simple. But the second set of good news is that if you're willing to put in the work and look at the fund descriptions and read the documents, you can definitely find funds that align with your personal values. Do you think Europe ETFs will outperform US ETFs this year? So I'm with Warren Buffett on this one. He said the only value of stock forecasters is to make fortune tellers look good. As soon as there is some new information released about what's happening with certain parts of the world, politically, economically, it gets reflected in stock prices, okay? So when the European Union announced that they're going to pull together and fund defense, okay, defense stocks immediately jumped. Other European stocks jumped as well. And the opportunity to jump in and make a big profit went away. Now, we can look at that past performance and we can say, yes, it should have been obvious that European stocks would do great this year, but it only becomes obvious in retrospect. Now, from today, looking forward, what's going to happen over the rest of the course of the year, I have no way to predict that because I don't know what Trump will do. I don't know what Putin will do. I don't know what Zelensky will do. I don't know what's going to happen in the economy, what new AI craziness will come out. So anybody who's trying to tell you they can predict which market will do better over the next 6 months, they're talking out of their behind, okay? They have no idea what they're talking about. The stock market is an extremely complex system. It is essentially a chaotic system. It is virtually unpredictable over the short term, and it's a waste of time to try and do it. That is why we invest in a diversified way and we invest for the long term instead of worrying about these short-term swings. Knowing that time in the market is better than timing the market, would you enter a global ETF like FWRA right now, or would you wait still a few weeks? So I think this question really illustrates why we need a saying like time in the market beats timing the market. Because even though we know it doesn't make much sense, we still want to time the market and guess when the right moment will come. The question is, what will those few weeks help you? Why do you imagine that a few weeks from now you will be in any better position than today to make that decision? It always feels uncertain. There's always doubt. If you wait for the perfect moment to invest, you will be waiting forever. If the market goes up, you will be worried because what if it falls? If the market goes down, you'll be worried because, oh, Trump is going crazy. It's tariffs. It's all horrible. What if it keeps falling? It never feels like a good time. Literally never. Literally never. Okay? So that is why time in the market beats timing the market. And on average, the best thing you can do is start investing and keep investing without worrying about these short-term swings in the market. Is there a tech bubble right now? The trouble with bubbles is that they only become apparent in retrospect. Now, I would think that with Dutch tulips centuries ago, yeah, a rationally minded person probably could have said, this is a bubble. There's no there. But with stock bubbles, it's much harder. For example, in the late 90s, the dot-com bubble, internet stocks, well, were people wrong that the internet was going to completely transform the economy? No. And like many of the most valuable companies in the world today are internet companies. It's just that the enthusiasm maybe went up too quickly, valuations got out of hand, companies which didn't have such great products got super high stock prices, and then people realized that was happening and it all crashed back down. And then the market kept going, okay? But there was a substance there. The people who bought internet stocks in 1999, many of them were not idiots, okay? They actually guessed the future direction of the economy quite correctly. So today we can look at AI and how that's going to transform the world. Now, when ChatGPT got released a few years ago, initially I got super excited, and then like many people, I was kind of disappointed that there were many things it really sucked at, and the hype died down. But I've been following AI news over the past years, and it's become very obvious that we are in the middle of a truly fundamental change, a revolution in how people work, in how the economy works, in how our entire world functions, okay? And there's going to be a huge productivity explosion that happens in the economy. There are going to be many stocks which do go to the moon based on AI technologies. I have zero doubt about this. But what I do not know is when that will happen and which stocks will be the ones that go to the moon. So it can absolutely be the case that we wake up tomorrow and investors realize, okay, AI is developing a bit slower than expected. The current valuations, they're not justified, and we have a crash. And then people will say, yeah, there was a tech bubble. But it can also happen that AI takes off even faster than we expected, and tech stocks just keep going up and up. So there is no reliable way to make that determination right now. We can only see it going backwards. So what can investors do? Well, we can invest in a diversified way. And if you are really worried about your portfolio's exposure to tech stocks, you can also use other investments, such as small cap stocks, which don't have this problem. Many investors recommend currency-hedged government bond ETFs to reduce volatility, but over the long term, the unhedged versions often seem to perform better. As long-term investors, should we always hedge? Okay, so hedging is not about improving your long-term result, it's about removing risk, okay? Now, when you're investing in the stock market, most experts recommend using unhedged funds, okay? Because the risk of the stock market is usually much bigger than the risk of currencies, okay? So if you're investing in stocks, the currency risk over the long term is usually not that important. But when you're investing in government bonds, in high-quality government bonds, usually it's because you want your investment to be really, really safe. So it doesn't make sense to buy this really safe investment, which doesn't move up and down a lot, but then suddenly not hedge the currency, so you'll get this currency risk messing up your portfolio. Okay, so that's the logic. That's why if we invest in global bonds, usually we use hedged investments. But if we invest in global stocks and we're happy to take a lot of risk, then usually unhedged is better. Now, also, you shouldn't expect that unhedged bond ETFs will always do better. So, for example, if you're investing in US bonds, then if the dollar gets stronger, then unhedged ETFs will do better. But if the dollar gets weaker, and Trump wants the dollar to get weaker, and many experts think it might get weaker, then unhedged bond ETFs would do worse. Okay, so this really depends on the time period and how the currencies move. Investing in Asian ETFs, is it worth it? If so, what are the best options to choose? Investing in Asian markets with ETFs is quite easy. For example, you can go to justetf.com, and under region, you can select Asia Pacific. So that gives you around 51 different ETFs to look at. Or you can go to country, and you can select China, or you can select Japan, or whatever Asian country you're interested in, and you'll have some good options to look at. Now, is investing in Asian ETFs a good idea? Well, none of us can predict the future reliably, so we can't predict if America will do better or if Asia will do better or any other market. But if you have a diverse portfolio which covers many different countries, regions, stocks, then that's a perfectly reasonable way to approach investing. So that means that if you're really enthusiastic about what's going to happen with the Asian economies and the Asian markets, you can go 100% with Asian ETFs. If you're neutral on it, you can include Asia as part of a global ETF portfolio, and either approach is perfectly justified by reasonable investing principles. But emerging markets also have significant risks, for example, political instability and less developed markets. And there are other periods like the past decade which have been really, really bad for emerging market stocks. Now, long-term, going forward, I personally include emerging markets in my portfolio. I think there's a lot of potential for growth there, but I don't put everything into emerging markets because I also see the risks. For example, in China, there is basically one person at the head of the Communist Party who can make radical decisions that affect all investors. The same was true for Russia, and we saw how that turned out. When Russia invaded Ukraine, foreign investors in the Russian stock market basically lost everything. So I don't want to put 100% into emerging markets, but I definitely think it has a very important role to play in a diversified portfolio. Could you explain how investing can generate passive income? Okay, so I'm going to assume we're talking about investing in ETFs and index funds, okay? And with these kinds of passive investments, there's basically two ways you can take out passive income. Some investors use what are called distributing ETFs or index funds. So these are funds that pay you dividends. So on a regular basis, you have some money landing in your account, and that's fine. The problem with this is that the amount almost never matches what you actually need for your spending. So what I personally do is I buy so-called accumulating funds, which don't pay me dividends. And whenever I need some money, I just sell a bit of my funds. Okay. So if you want to have a fixed stream of passive income, for example, 5,000 euros every 3 months, then you can simply set up a calendar reminder every 3 months to log into your brokerage, to sell a bit of your fund units to generate 5,000 euros, and that's it. U.S. financial advisors often recommend a 60% allocation to stocks and 40% to bonds. What is the European equivalent? Okay, the stock versus bond allocation debate is not really about Europe versus America or other continents. This is a question of how much risk are you willing to take in your portfolio at any given point in time. The classic theory is that when you are young, when you've got a long time to invest, you can afford to take a lot of risk. For example, you can put everything into the stock market, 100%. And as the market goes up and down, okay, it can be a little uncomfortable to see losses in your account, but you have plenty of time. You can wait for the market to go back up, and that's fine. But when you get older, when you get closer to retirement, you can't risk all your capital in the market, okay? So you want to put part of your money into lower risk investments which don't swing up and down quite as much. So there you introduce more of a bond allocation. And there is this classic advice that by the time that you reach retirement, you want to have no more than 60% in stocks. Some people say 40% in stocks, 50% in stocks, and the rest is in bonds or other low-risk investments. And that's completely doable here in Europe, the same as it's doable in America. Now, there is an interesting twist to this story. Some recent academic research by Professor Scott Cederberg actually suggests that from a financial perspective, it would be smartest to have 100% in stocks all your life, okay? Because bonds, even though they appear safer, they don't swing up and down in price so much, they perform so poorly compared to stocks that they don't often even cover inflation, okay? So from this perspective, having everything in stocks would be smartest. But the big problem with that is called risk composure. People are not actually able to tolerate having 100% of their wealth invested in stocks, because if there's a big crash, like 15 years ago when the stock market crashed 50% within a single year, people freak out, they make mistakes, they sell their investments at a bad time, and they lose money. And this is why most financial advisors would recommend you to keep at least part of your investments in lower risk assets as you get older. How to choose the best European ETFs? Okay, so I'm assuming this question is about ETFs which invest in the European stock market. And recently, with this rift between Trump and the rest of the world, a lot of investors have been asking, what is the best way to invest in Europe? Now, the principles for choosing European ETFs are the same as with any other market. You want to look for broad, diversified ETFs, which invest in hundreds of different companies with low costs. And the easiest place to find these funds is on justetf.com. Okay, so we can go here to equity. So those are stock ETFs. Under region, we select Europe, and we've got lots of different choices. Now, to select a specific ETF for your case, you will have to look at some technical aspects, such as accumulating versus distributing ETFs and physical versus synthetic ETFs, and other technical nuances, which I actually cover in this channel, but your starting point is justetf.com. I'm 52 and I plan to retire at 67. Based on current pension contributions, I'm projected to receive less than 40% of my current net income in retirement. What options or calculations should I consider if I want to retire at 60 and cover the gap to reach at least 80% of my current income? Okay, so basically there's somebody who's expecting to cover 40% of their current income with pension, and they want to cover another 40% with investments. Okay, so we can play around with some numbers. Let's look at Google Sheets. So let's assume that this person is making 4,000 euros net per month. Okay, so 40% of that would be 1,600 euros in passive income that we need. Annually, that would be 19,200 euros. And to estimate how much capital you need in order to generate this much passive income, we just multiply that by 25. Okay, this is based on the 4% rule. And this would tell us that we need around 500,000, so 480,000 euros in capital. All right, so this person is 52 and plans to retire at 67. So that's 15 years from now. So we need to accumulate 500,000 in 15 years. Is that doable? Okay, so we can play with a simple investment calculator to see if that's doable. All right, so we've got 15 years. Now, I don't know how much this person has right now. Hopefully they have at least a bit of savings, let's say 25,000 euros. And then if their monthly income is 4,000 euros net, let's say they are saving 20% of that, so that would be 800 euros per month. And then let's say every year until retirement, they can increase the amount that they are saving by, let's say, a moderate 4% per year. Now, for the annual profit level, I'm going to assume 7% per year because this is an older person who will probably not be doing the most aggressive kind of investing. And then we get this result. With these numbers, over 15 years, this person would put away 217,000, have a profit of 169,000. So the final balance here is 386,000 euros. So it's not 480,000. We still have a gap. So if we save 1,200 euros per month, that's 30% of the income, then that would take us comfortably over 500,000. And it's good to have that extra buffer because inflation is going to keep on inflating. So the cost of living will probably go up over time. Could you show us an example of a diversified long-term ETF portfolio? Sure, I can show you many. There are actually many different ways to have a diversified portfolio. On justetf.com, we can look at global ETFs. For example, any single of these top global ETFs would already give you a very diverse portfolio. iShares Core MSCI World invests in 1,500 different stocks in developed world countries. The Vanguard FTSE All World invests in several thousand stocks in both developed and emerging markets. You can buy one of these funds and already have a diverse portfolio. Now, there are some technical nuances there. This is not an investment recommendation. You have to consider your individual case. But yeah, one of these ETFs can be quite enough. You can also invest in just one region. For example, you can have a European ETF from here, or you can have North American or US ETF, which invests in hundreds of different stocks. And that can also be a good, diversified, long-term portfolio. There is not just one way to invest that is smart and good and correct. You can have many different ways of building diverse portfolios. How much time and money is needed to invest to get to £100,000 in 10 years? Well, for the time, I'm guessing 10 years, okay? But for the amount of money, we can play with a simple calculator. So you've got 10 years. Let's say you're starting with zero. Let's say you can maybe invest £300 a month. And then every year as your salary goes up, you can bump that up by 5%. And let's say you get the average long-term profit in developed world stocks, which is 9% per year. Well, then in 10 years, you'd have £69,000. Okay, so roughly if we want to get to 100,000, let's up that to 500. And yeah, that gets you to 116,000 pounds. Now, obviously, we're making assumptions here about what the profit is going to be and how much you increase your contributions every year, but this gives you a ballpark estimate. Where should I keep my emergency fund if I live in Europe? Okay, so I assume this question is about what I call a safety cushion. You should always have some money that is not invested, that is sitting in a safe place so that if you have an emergency in your life, if you lose your job, if something happens, you have money to live off, okay? This is really important because if the market crashes and at the same time you lose your job or your car breaks down, you don't want to be forced to sell your stocks at a really bad time. So having this kind of emergency fund is really important. That's good thinking. Now, in most European countries, you can find good high-yield savings accounts. So this is a bank savings account which pays you a few percent per year. In countries where your local banks don't pay a good rate, you also have some alternatives. You can use international brokerages which have a banking license, such as Trade Republic or Saxo, which have some decent rates on the money you keep in your account. You can use global banking platforms like Raisin, or you can buy so-called money market funds, but that gets a little more technical. Investing in index-based ETFs is getting more and more popular. Is there a so-called index bubble in your opinion? Okay, so at the core of this worry, there is something that's legitimate. So if you had this world where 100% of all investors are passive, meaning that you just invest in the whole market in every single stock, then this would be a problem because there would be no good mechanism for the market to discover fair prices for a stock. Nobody would actually read the financial statements of companies. Nobody would figure out what is a fair price to pay. But this is a theoretical construct that's never going to happen because there are always going to be people who think they are smarter than others. They can spot opportunities in the market. They can find good stocks to buy, and they set the prices for stocks. Now, the people who spread this fear about the index bubble are usually people who are selling you their expensive, actively managed funds. They want to tell you, well, those index funds and ETFs, those are dangerous. Give your money to us and we will manage the money for you. But the sad thing is, first of all, these actively managed funds have a terrible, terrible track record. The vast majority underperform index funds. They get worse results. And the second really sad thing is that so many of these active funds are actually closet indexers themselves. They basically copy the index, invest in the whole market with just some small tweaks here and there, and they charge you a big fee for doing that. So in reality, the switch from active to passive investing, it hasn't really changed where investment funds invest your money so much. What has changed is that you're no longer paying ridiculous fees to get your money invested. Where to start my financial literacy journey? Well, first of all, you're obviously in the right place. Make sure to hit subscribe so you don't miss my next videos. But then there's also a couple of books I would recommend. The first is The Little Book of Common Sense Investing by Jack Bogle, the index fund innovator. Warmly recommended. And the other one I really love is The Psychology of Money by Morgan Housel. Okay, so start with those and then you're off to a good start. A lot of your content focuses on long-term investing. What would you suggest for the short term? Well, I kind of answered this when talking about your emergency fund, okay? So for really short-term investments, I would look at either a high-yield savings account or a money market fund. What are some good indicators of when it's a good time to buy more stocks or ETFs? Well, here's the indicators that I use. First of all, do I have some extra cash sitting in my bank account? Second, do I not need this money for my safety cushion, for my emergency fund? And third, is the market open right now? If so, then it's a good time to buy, okay? So-called market timing doesn't work. Predicting the right times to buy and sell doesn't work. There's a reason Nobel Prize winner Robert C. Merton called it a fool's errand. So what evidence tells us is if you've got money available, the best idea is to invest it as soon as possible and not look for the perfect time. When you invest in ETFs for the long term, 10 plus years, is there an appropriate point to sell everything? Well, you can't pick a perfect time to sell. The best thing you can do is set up a plan ahead of time. So if you're investing for passive income, then you will simply plan that every month or every 3 months, you log into your brokerage, you sell a bit of your ETFs, you take out the money, and that's it. Don't worry about the market. Don't try to find the perfect moment. Just go ahead and follow your plan. If you need to sell everything so that, for example, you have money to pay for a house, then what you need to do is lower the risk level in your portfolio gradually as the time approaches, because you want to avoid the risk that at the last moment, just when you need the money, the market crashes and the funds are not there. What are the tax implications for a person in Europe buying the Vanguard S&P 500? Okay, so investment taxes usually don't depend that much on whether you're buying the Vanguard S&P 500 or some European or Asian fund. The only nuance that I would think of is U.S. dividend taxes. Okay, so if you buy S&P 500 ETF, then S&P 500 companies pay that ETF dividends, and the U.S. does charge a tax on these dividends. Now, the exact tax rate will depend on where your ETF is based. If it's an Irish ETF, it's 15%. If it's a Luxembourg ETF, it's 30%. But as far as U.S. taxes are concerned, that's pretty much it. Okay. Now, beyond that, you have to pay some taxes of your own in the country where you live. And these taxes don't depend on the investment. They just depend on like how much money you're getting. Okay. So usually there will be some dividend taxes that you have to pay in your own country. Usually there's some capital gains taxes. So what that means is when you sell this ETF at a profit, then you need to pay some tax. In some countries like Belgium, you also have transaction taxes. That means every time you buy or sell, you have a tax to pay. Obviously, this gets a little nuanced. I've got some other videos about this, so I won't get into a lot more detail. Best ways to save for kids' education in 15 years. So people ask me this a lot. They want to know, is there some kind of special investment account that I can set up for my kids? And in some European countries, you have these accounts. For example, in the UK, you have the junior ISA, which can be quite interesting. In most European countries, you don't have them. So what most people do is you simply have your own investment account. And in a corner of that account, maybe there's one ETF that you buy specifically for your children. So the idea is you invest in your own name today, and when your kids become 18 or whatever target age, then you can make a gift to them. Now, this has both advantages and disadvantages. The advantage is that you retain control of the money. So if your kid turns 18 and it turns out they're not very responsible and they just want to buy a BMW, well, you still have control of the money. You can decide what happens. The disadvantage is if somebody sues you, if you get into debt, then this investment, which you meant for your kids, could be under threat, okay? And of course, you also have to take into account if there are any gift or inheritance taxes when you give this money to your child later on. Do you track moments when you bought? Do you use any sheet to track your investments with dates, amounts, and prices? Yes, in almost all European countries, you should do this. This will make your tax calculation and tax payment so much easier. Now, there's actually an interesting quirk. I personally don't do this because in my country, you don't have to pay tax based on when you buy and sell. You have to pay tax based on when you put money into your account and when you take it out. There's kind of a different system. But this is an exception. In most cases, you want to keep close track of when you buy and at what price, when do you sell and at what price, when do you get dividends, and that makes reporting and paying your taxes at the end of the year much easier. Now, of course, Europe has 30 plus different tax systems, and there are actually many little exceptions and quirks like this depending on your country. And this is something we cover in the Index Masterclass, our training program for European investors. So if you're interested in that, there's a link in the description that you can check out. If the brokerage firm you are using to invest goes bankrupt, what will happen to your investment? Well, if you chose a legitimate licensed brokerage, then your money should be safe. Okay, so the way brokerages work is your investments, they are held separately from the brokerage's own assets. So even if the brokerage runs out of money and gets into trouble with creditors and has to go bankrupt, your investments should still be protected. Now, there can be issues with incompetence or with fraud, which could threaten this. So you definitely want to choose brokerages with a good reputation where you trust the management team. But in principle, it's quite safe. And also in practice, it's very safe. I'm not aware of any cases where investors ended up losing money because of brokerage failures. There have been a couple of loud examples where it took a few years to work everything out and get the money back, but usually the mechanism works quite well. Are ETFs diversified enough? Now the USA makes up 60+% of the global stock market. So yeah, all world ETFs do put around 60% of their assets into the US market. Now the US market is actually quite globally diversified because many American corporations make a lot of their money globally. But this does expose you to things like American political risk with Trump being at the helm, okay? If you want to avoid that, you can add what's called home bias. You can invest a little more into Europe to reduce the exposure to America. I personally am comfortable with this risk at this point in time. I still have a global portfolio, so that means around 60% in the US market. How do I pick the right platform to invest from? I assume there are many. Yes, there are indeed many brokerages and investment apps and platforms that you can use for investing. The first step is to make sure you don't fall for a scam. So if somebody's sending you a link to their marvelous investment app over WhatsApp or Telegram or Signal, 9 times out of 10, that's a scam. Even if it looks like your friend is sending you this link, often accounts get duplicated or hacked. So be very, very careful. Research brokerages online, find reputable sources, and go directly to the brokerage website, okay? The next step is to make sure this brokerage is licensed. It needs to have a license to provide investment services in your country. Now, once these basics are covered, you want to think about things like how reputable is the brokerage, how financially strong is it, what is the customer service like, what are the fees like, and is it good for taxes in your country? Now, there are some brokerages that I really love, such as Interactive Brokers or Saxo or DeGiro. Trading 212 can be good. It's very simple to use. Trade Republic can be good. Some people like to use Revolut because they already use it for their daily banking. Lightyear is a cool new startup based in Estonia, which is very convenient for investing. But you do want to consider this carefully, looking at your personal situation, because in some countries like Germany and Austria, it's important to use a local brokerage for taxes. More advanced investors sometimes prefer technical brokerages. Beginning investors prefer simpler brokerages. There's some nuance to consider. How much do I need to start investing? Well, these days with low-cost brokerages, you can even start with 10 euros a month if you like. Okay, just make sure that your brokerage charges very low fees or no fees for ETF investing. For example, Trading 212 is like this. Lightyear is also like this. And you can basically start with as little as you like. What is the chance and what to do if the fund where we invest our money for like 25 or 30 years gets closed? So this does happen from time to time. I've had it happen to me several times as a professional investor, and it's not a major issue. So if a fund closes down, it simply returns the money to investors. Now, the one big downside is that this could create a tax event for you, where you need to pay tax on any profits up to that point. So I do prefer to pick funds which are large. They have a big size, they are popular, and this means that they are much less likely to get shut down. But if it gets shut down, you simply have to pay the taxes and then you reinvest the money into a different fund. Say I turned 65 or 70 years old. I'm finally ready to retire and I've amassed 500,000 euros. How do I live off of it? Do I withdraw whatever I need to live each month or do a one-time withdrawal once a year? Okay, so the first thing you would need to figure out is how much passive income can your portfolio actually support. There are different methods that people use to estimate this. Perhaps the most popular is the so-called 4% rule. So the idea is you take the amount that you have at retirement, you take 4% of that, and that's the passive income you can take out every year, plus you increase it by inflation every year. So if we just play with some numbers here, and if we've got 500,000 euros saved, then 4% of that is, of course, 20,000 euros. So that means you could take around 1,670 euros every month. Now, you can do it every month. Just log into your brokerage, sell a bit of ETFs, take the money out. You might do it once a quarter. I would not do it as rarely as once a year, just because then you'll have a whole bunch of cash sitting around for a whole year, not earning any profit. Now, not everybody agrees with the 4% rule. Some people say it's too aggressive and that you should be taking out less, but it's kind of a starting point that you can look at. So the logic behind the 4% rule is to make sure that even if you have a really bad market situation and there are crashes just at the wrong time, you still don't run out of money while you are alive, okay? So in a typical case, a 4% rule is actually very conservative. You might have a whole bunch of money left over when you pass away, which I guess is not bad if you have kids and you can leave it to them. Whereas in a really bad situation, a 4% rule might be cutting it close so that you barely scrape by, you can take out the passive income that you need, and you don't run out of money. I've heard of the really rich borrowing money from the banks against their stock value. Do we mortals get to do the same, or does this only apply to the ultra-wealthy? Okay, so the reason the ultra-wealthy do this is basically to optimize their taxes. Okay, so let's say you are worth 5 billion euros, but you spend 10 million every year to support your lifestyle. Now, you could sell 10 million of your stocks every year to fund your spending, but then you would have to pay tax on the stocks that you are selling. Okay, if you've got a profit, you have to pay tax on that profit. So instead of that, why not borrow the 10 million from your bank or brokerage? The bank sees, okay, you've got 5 billion, you are clearly good for it, so they will be happy to lend you some money. And because you're borrowing, it's not a profit, you don't have to pay tax on it, you can spend. And the following year, you can borrow another 10 million, and the year after that, you can borrow another 10 million. In fact, if you are worth 5 billion, that's 500 years worth of 10 million of spending. Okay, so you will basically never run out of money. You never have to repay the loans. You just pay a bit of interest, and it's much more efficient than paying taxes. Basically, the ultra-wealthy can just keep borrowing and borrowing and borrowing to fund their daily spending and never really feel any significant pain from the size of the loan or from the interest payments. They can do it for the rest of their lives. Now, as a regular person, you can do a version of the same. You can borrow money from your brokerage or bank against your portfolio, and you can spend this money for a few years, maybe even for a decade. But usually, the loan amount will be quite significant at this point. The interest payments will be quite significant for you, and the risks will also be quite significant. If you're borrowing a large amount of money, a big chunk of your portfolio, well, what if the brokerage or bank asks you to quickly repay? Are you going to be able to get the money somewhere to repay them? For a billionaire, it's no problem. For you, it might be difficult. Or what if the stock market has a major crash by 50 or 60%, and suddenly the value of your portfolio is no longer enough to cover what you owe, and the brokerage does a margin call. They request that you pay up the difference, okay? This can quickly drive you into real financial trouble. So for most regular people, yes, you can borrow against your investments, but it's probably not as practical and safe as for billionaires. Why can ETFs of the same index have different results? Well, usually, if these funds are tracking the exact same index, the results will be very, very close. There can be some differences because of different cost levels, different total expense ratios, and also because of differences in taxes. Okay, there are some technical reasons why, for example, synthetic ETFs, which invest in the US stock market, can get slightly better results than physical ETFs because they can avoid paying some taxes, basically. But those are the main sources of difference. Now, a lot of the time, people think that two ETFs tracking the same index have different results, but actually they are looking at results in different currencies, okay? If one fund is showing results in dollars and the other fund is showing results in euros, then you also have to take into account the changes in currency exchange rates, and that can cause the apparent difference. How much of our portfolio should be allocated to hedging, and which asset classes should we use for hedging? Gold, real estate investment trusts, commodities, maybe even crypto. Okay, so in investing, hedging refers to removing a specific risks. For example, if I invest in the US stock market as somebody from the Eurozone, I'm exposed to the euro-dollar exchange rate, okay, the currency risk. And I can hedge this risk away by using a currency hedged fund, all right? I think what this question is really about is not hedging, but diversification. So sometimes if we add assets to a portfolio which are not correlated, which don't move together with our primary investments, that can diversify, it can reduce the price swings. Okay, so if we invest everything in stocks, the portfolio swings up and down with the stock market. If we then add bonds, well, bonds go up and down at different times as stocks, so that can kind of reduce the overall risk of the portfolio. It can diversify. Now, some people like to add a bit of gold to the portfolio also for the same purpose. I'm actually not a big fan because what I care about at the end of the day is not necessarily the optimal risk level or, the risk-adjusted returns that finance geeks talk about. I care about the actual returns. And when you look at gold long-term returns, they have not been impressive. They have been much weaker than stock returns with higher price swings, okay, with higher risk. REITs, real estate investment trusts, are a form of real estate stock. They are already included in stock ETFs, but if you want to overweight this can give you an extra exposure to the real estate market, it can be a sensible strategy. There's no hard and fast rule how much you should put into that. It really depends on your conviction about this sector of the market. Other commodities I don't think are particularly appropriate for most regular investors. And when it comes to crypto, well, I'm not a crypto person at all. It's basically high-risk gambling. If you love it, you'll have to find some crypto influencers to tell you how to do it best. What type of investment can you suggest to a person who just started his career with zero money in the bank? Well, I mean, it's very simple. Just buy a low-cost, diversified ETF or index fund. In most European countries, ETFs will be easier to buy. You can buy them with a low-fee brokerage like Trading212 or DEGIRO. Just put a little money aside every month, buy an ETF, and that should be good. I'm retired with a substantial portfolio, which I intend to keep. How to draw income out of it? I prefer dividend ETFs to the 4% rule. Okay, so this really depends on what you're trying to accomplish with this passive income. If this passive income is supposed to be your main source of income that covers your daily spending, then you will probably want it to be quite stable, quite reliable from month to month or quarter to quarter. And the challenge is that if you fully rely on dividends, you can't ensure that this will happen. Some periods you will have a higher dividend yield, other periods you will have a lower yield. So if you don't want to constantly adjust your actual spending, you will have to do something else. Now then, some people say, I will invest in reliable, strongly profitable companies which always pay a steady dividend. But these kinds of companies, for example, utility companies, they also tend not to have the best long-term profits overall. Okay, the stock price tends to not go up as much, and they might just not be such great investments. So by tying yourself to just dividends, you kind of limit yourself. Now, it's completely fine to have dividends as part of your passive income strategy. But in that case, the approach I would take is I would define, okay, what is the amount of passive income that I need every quarter? Maybe based on the 4% rule or something similar. And then at the end of the quarter, I would check, have I gotten enough from my dividend payments? If not, I would sell a little more to get what I need. And by contrast, if I got too much, I would perhaps reinvest that, okay? Keep the money in the market. And this would allow me to smooth out the unevenness in dividend payments. What would you think is better, investing in one all-world ETF or three separate ETFs, the S&P 500, European market, and emerging markets? Well, in most cases, it will be much easier to use an all-world ETF. Okay, your three ETFs don't cover the whole developed world, for example. You're missing developed Asia. And if you have multiple ETFs in your portfolio, you have to keep them balanced, and tax reporting gets more complicated. So usually it's easier to just buy one global ETF. If you're concerned about having all your money in just one ETF, you can also have two global ETFs, and that can be fine as well. What are your thoughts on leveraged ETFs? They are dangerous speculative instruments, and basically most regular investors should stay away. It's an easy way to lose your money. Okay, so these are ETFs which, if the market goes up 1%, they go up 2% or 3%. Or vice versa. If the market goes up 1%, maybe they go down 1%. And they can seem attractive. For example, you might imagine that, okay, well, if the market always goes up long term, why don't I take a double the market approach, okay? Let me buy a 2x S&P 500 ETF, so if the market goes up 10%, I'm going to be up 20%. But there are technical nuances and technical reasons why over the long term, this doesn't actually work out. So from day to day, yes, if the market goes up 1%, you get 2%. But over 10 years, if the market goes up 50%, you don't get 100%. You might end up getting 60 or 70%. And if the market has sharp drops, you can really lose a lot of your money quickly. So for most regular investors, leveraged ETFs are a dangerous game. I'm currently investing in 5 to 10 ETFs with low total expense ratios that cover global markets, including the US, Europe, Australia, and emerging markets. Is this too many, or is it a sustainable strategy? I mean, it's probably better than what your local bank would typically sell you here in Europe, which would be expensive traditional investment funds. You would probably get a better result with your existing strategy. That said, 5 to 10 ETFs for most regular investors sounds like a little too much. Usually I see problems with overlapping funds. So maybe somebody will have a global stock ETF and then a US stock ETF, and they overlap. And then there's a European stock ETF, and then there's German stock ETF. And so there's all these overlapping pieces, and you don't have a clear picture of what the overall strategy is. You're not sure how to keep the portfolio balanced over time. And this can lead to all kinds of mistakes and attempts to time the market. And it makes tax reporting more complicated, and the brokerage fees are higher because you're buying and selling. Usually, if you can stick to 2 or 3 ETFs, keep it simple, you get better results. How can I reduce commissions when buying stocks? It's a huge problem when there is little money to invest. So this is why picking the right brokerage is so important. Beginning investors will often prefer a low-cost or zero-commission brokerage. This can allow you to invest in the market very, very cheaply or even for free, especially if you invest in stock ETFs. There are several brokerages such as Trading 212 and Lightyear which allow you to buy stock ETFs without any commissions at all. If I can get a larger mortgage at an interest rate below 4%, is it better to take the bigger mortgage and invest my savings, or go with a smaller mortgage and invest less? Okay, so up to a certain point, taking a bigger mortgage and investing more totally makes sense. Okay, the long-term expected return from the stock market is much better than what you would be paying on such a mortgage, so it's a smart financial trade-off. But it's only up to a certain point. You want to make sure that the mortgage isn't so big that if conditions change, it creates financial risks for you, okay? So if interest rates go up, for example, and your monthly payment shoots up, make sure you can cover that. Make sure that if the house price drops a little, you are not suddenly underwater, because that can be a psychologically very unpleasant situation, okay, where the value of your house is smaller than the outstanding balance on your mortgage. Okay, so yes, it can make sense to have a bigger mortgage and leave yourself more room for investing, but make sure it's not so big that it's putting you into risk or creating psychological downsides for you. Does it make sense to diversify investments across different platforms and brokerages for safety? Or is it better to keep everything in one place to benefit more from compounding? So compound interest works the same whether all your investments are with one brokerage or with 10 different brokerages. The only potential issue is if every time that you buy and sell investments at a different brokerage, you have to pay brokerage fees. So in that case, instead of just paying brokerage fees once, you might be paying them 10 times, and that can really add up. But if you are using low-cost brokerages, it really does not affect your investments in any negative way to have 2 or 3 brokerages as opposed to one. I personally have 15 different brokerage accounts, but well, that's because I research brokerages. My primary accounts are around 3 or 4. And I do like having that diversification because at this point, I've got a large sum of money, most of my family's wealth invested in the market. So even though brokerages are extremely safe, I don't want to have everything sitting in just one financial company. Okay, so I've got a brokerage that's based in Denmark, one that is based in Latvia, another one that's based in Ireland, and this gives me some extra comfort that I'm well protected, even if there are some geopolitical or other risks. What about bonds? Can I buy bonds as a private person, and if so, how? Or is it best to invest in bond ETFs? So I always talk about how stock picking is difficult. Well, bond picking is actually 10 times as hard. Because buying individual stocks, at least you have transparent market information from the stock exchange. What's the latest bid price, the ask price, what transactions are happening? It's relatively easy to figure out the fair price of a stock. And most big stocks are quite liquid. They are easy to buy and sell. With bonds, it's a whole different ball game. Information about market prices is hard to find. Liquidity can be really, really bad. It can be hard to buy or sell a bond. It can be very challenging to calculate a good price for a bond. And in many cases, the brokerage that you're dealing with, they are working against your interest. They want to sell you the bond at a bad price. So unless you are a bond expert, in most cases, buying individual bonds is quite dangerous. It's not a good idea. There are some exceptions. Some countries offer direct bond purchase programs where you can buy the bonds of your government at low cost, and this can be fantastic, especially if you get tax benefits. But for most regular people, bond ETFs and bond index funds will be a better choice. So with one of these bond funds, you get a diverse portfolio of different bonds. Your risks are lower. All the mechanics are taken care of by the fund manager. You can just buy an ETF like any other ETF, and that's it. Now, bond ETFs have their own nuances and downsides, but that's quite a broad topic, so maybe I'll cover it in a separate video. Assuming a well-diversified portfolio of ETFs and a limited amount of money to invest each month, is there a meaningful difference between investing in 3 ETFs equally or 9 ETFs equally? So it's hard for me to imagine any scenario where a regular investor would need 9 ETFs in their portfolio. Maybe you have some weird strategy that requires this, but in most cases it's overkill. Plus, if you have to pay a minimum brokerage fee every time that you buy and sell, then 9 ETFs can just really destroy your profits. So I would try to keep it simpler and keep the number of ETFs more manageable. What funds should I buy for my children's future, so that's 10, 15 years in the future, in the most tax-efficient way? Okay, so obviously this will depend on the tax rules in your country, but in most European countries, in this case, you would want accumulating ETFs or index funds. So these are ETFs and index funds which don't pay you dividends. They keep all the money inside the fund. That means you will not be paying taxes every single year as you wait for your kids to grow up. And only in the future, when you sell the funds and when you take out the money, then you pay the tax. So that's the rule in most European countries, except some countries like Austria and Switzerland and Denmark and the UK, where accumulating funds get taxed every year. Now, in some specific European countries, you might have some additional tax-optimized accounts for investing for your children. For example, the junior ISA in the UK. If that's available, look at that, but in most countries, you don't have these instruments. If an investor would like to include 1 or 2 bond ETFs in his portfolio, what criteria should he apply when picking those ETFs? Well, the first question is, what is the purpose of adding these bond ETFs? So the classic reason why people add bond ETFs to their portfolio is to reduce the price swings, to reduce the risk as they get older. And if you're using bond ETFs to reduce risk, then you will probably be looking at investment grade bonds. So these are bonds which are issued by high quality issuers where there's a low risk that they will fail to pay you back. Okay, so we're talking about investment grade ETFs. And the other aspect of risk to think about is the typical bond maturity. How many years is it until the bonds in the ETF mature and pay you back the money? The longer the maturity, the higher the risk, the higher the price swings. For long-term passive income investing, usually people would use a total bond market kind of fund. So that has an intermediate kind of typical maturity. If you are making an investment for a shorter period, for example, for 3 to 5 years, then you might have a bond fund with shorter maturities. And if you're making a very short-term investment of just a few years, then you might look at money market funds, okay, which have very, very short-term bonds, very high quality. It's basically as good as keeping your money in a high-yield savings account. How do bond ETFs work? Okay, so when you buy a bond, it's basically a loan to a company or a government. Right? So, for example, a Coca-Cola bond would mean that the Coca-Cola company in the future will pay you back a certain amount of money called the principal, and then every year until then, they will pay you a coupon, an interest payment of whatever percent. Okay? Now, a single bond can be difficult for most regular people to buy, and it's also a bit risky because you're exposed to the credit risk of a single issuer, right? So we can use bond ETFs to diversify, to invest in hundreds of different bonds at the same time. Now, there's a nuance with bond ETFs where if a single bond has a set maturity, for example, it matures in 2030 and that's when you get your money back. With most bond ETFs, you don't have that, so the bond ETF just keeps rolling forward. And that has some interesting implications for risk. Now, interestingly, in recent years, there have also been some fixed maturity bond ETFs that have been released in the market where you can buy an ETF which only holds bonds maturing in December 2028, for example. And that can be very interesting if you know for sure that in December 2028, you will need a certain amount of money. How overvalued is the stock market at the moment? Is it possible that returns will be negative even for 15 plus years, mainly the S&P 500? All right, so predicting future stock market returns is notoriously difficult, okay? But we can look at certain indicators and try to draw some conclusions. And the reason many people think the US stock market could be overvalued is tied to these so-called PE ratios, stock valuations, okay? So a PE ratio just tells you how expensive a stock is compared to how much money the underlying company is making. The P is price, E is earnings per share. You divide the price by the earnings per share, you get the PE ratio. And if you look at this picture of PE ratios in America, that's the blue line, versus Europe, that's the orange line, you see that since around 2010, valuations in the U.S. market have shot sky high, and they are at one of the highest points historically, okay? So compared to history, American stocks do appear to be quite expensive. Now, some people think that this is a bubble and it's caused by too much U.S. government spending and printing money and all these things, while other people argue that this is justified because the U.S. stock market today is dominated by these highly profitable and fast-growing tech companies. Tech companies which are, by the way, at the forefront of the AI revolution. And so this justifies the stocks being expensive because the future earnings growth is expected to be high. You're expecting these companies to make much more money in the future. So what you expect going forward really depends on who you think is right. Now, high PE ratios generally have been associated with lower future returns. If you're paying a lot to buy stocks, you could expect to be making less money in the future, okay? But according to a study that I saw from Vanguard, this only explains about 40% of future returns. So it's certainly not a sure thing. I personally think we are at the beginning of a crazy AI productivity boom and total economic revolution that's going to transform society and transform the economy in profound ways that we don't understand today yet. And it's really difficult for me to predict how that will be reflected exactly in the stock market. But for that reason, I'm not at all inclined to think that, yeah, the U.S. market will definitely crash. It's all going to go down. I think it might surprise us all. Is it worth it to invest in two ETFs at the same time? For example, Vanguard S&P 500 and SPDR MSCI All Country World Investable Market. Okay, so these are two separate questions. Is it worth it to invest in several ETFs at the same time? Well, sometimes yes, if your strategy requires it so that you can achieve a certain effect, like investing in a combination of markets that's not available as one fund. But is it worth investing in these two specific funds? Well, I don't know what you're trying to accomplish. But what I do notice is that the SPDR All Country World Investable Market Fund is going to overlap a lot with the Vanguard S&P 500 fund. It's probably going to include all the S&P 500 stocks in it. So by adding the S&P 500 fund, you're putting an extra emphasis in your portfolio on the U.S. stock market. So to me, that would make a lot of sense if you believe in the strength of the U.S. stock market and you want to put more of your money there. Just keep in mind that an all-world fund already invests around 60% in the U.S., so this means you are pushing up the U.S. exposure even higher. If I invest 1,000 euros per month, how long is it until I reach 100,000 euros in my investment portfolio? Well, it's time for our trusty investment calculator. So we've got 1,000 euros per month. Let's say the stock market profit is the long-term average. It's 9%, and I want 100,000, so let's try 7 years. Okay, we get 115,000, maybe 6 years. We get 94,000. So the answer is between 6 and 7 years. You've mentioned in previous videos that after returning to Europe, you did consulting and training work for a time. What was your investment approach and strategy during that period, having irregular income and not earning as much? How should a freelancer approach investing? Well, so let me answer that in two parts. The first part, how did I do it? And the embarrassing truth is I really didn't. I've told this story many times. In my 20s, after I moved back to Europe from America, I mostly had fun. I danced salsa, wrote books, and traveled and spent a whole bunch of money. And there was nothing left over to invest. And by the age I was 30, I had like 900 euros left in the bank. And that's when my wife got pregnant and I got so scared I couldn't take care of my family. And that's what really put me on the road to, okay, let's make a lot of money. Let's start saving. Let's start investing and building wealth. So that was my story. I wish I had a better answer there. But the second question, how should a freelancer invest? I can totally resonate with that because today I'm an entrepreneur and my income is very unstable. We can have fantastic months or even a fantastic year, and then we might have a year with nothing left over for investing. And my basic approach is that I have a budget for what I need to spend, okay? So when I take dividends out of the business, I will put that money aside for my family's spending, and if I'm able to take out more, all of that I will just put into the market. And of course, this is on top of safety cushion that we have sitting in a high yield savings account and making a few percent per year. Okay. So if you can't predict exactly how much you will be able to save and invest every month, it's not really a problem. You just have to have a plan for how much money you need to be taking out of your business to cover your spending. Make sure that is covered first. Make sure you have your safety cushion as well. And then anything extra, anything above that, then you can put that into the market. Is it risky to only hold a portfolio managed by a single brokerage or fund platform? So on the whole, if it's a licensed, legitimate, regulated brokerage or platform here in Europe, the risk is very low. It is extremely unlikely you could lose money because the platform collapses, because your money is protected. And even if they do collapse, you don't lose your investments. That's how it's supposed to work. And in practice, virtually always, that's how it works. But virtually always doesn't mean 100% always. There's always this tiny little bit of residual risk. And there can also be technical issues, like your brokerage might decide that you look suspicious and they want to investigate where your money came from, and your account can get locked for months. This happens to people a lot, okay? So for these reasons, I personally like to have 2 or 3 different brokerages so that I diversify a little bit. Now, I wouldn't start doing this with my first 5,000 euros maybe, but once you're investing tens of thousands or hundreds of thousands, I would think about having a couple different accounts at least. If you're planning long-term, does it make sense to DCA a single all-world accumulating ETF to ensure diversification across geographies and sectors? Any risks? Now, okay, DCA would be dollar cost averaging, the idea being that every month as you get your salary, you take part of the money and you put it into the market and you're averaging out the different stock prices over time. And yeah, I mean, that's generally a smart way to invest when you are investing your regular income, okay? And for sure, an all-world diversified stock portfolio can also be a very good investment choice. Now, this is not a recommendation for you specifically. Of course, you have to consider your age, your goals, how much risk you're willing to take, and all of that. But in general, yeah, an all-world diversified portfolio can be a great choice. So far, I've been buying index ETFs, S&P 500, MSCI World, but they are all in the red now. Is it better to still keep buying these or to buy some growing sector-specific ETFs like defense stocks? Well, take this thought to the natural conclusion. If you're investing for the long term and you're investing in the global stock market, every time that the market goes up, you're happy, you keep investing. Every time the market goes down, you stop investing and you only buy some other funds which are going up. Don't you notice that you will end up just buying stocks when they are more expensive and refusing to buy them when you can get them basically at a discount? So this is a clear example of market timing, and it does not work, okay? If you want to profit from long-term stock investing, you have to be ready to keep investing when the market goes up and when it goes down, and over time it all evens out. And as far as sector-specific investing goes, at certain times, it can work out in your favor, but it's extremely difficult. It's actually one of the most tricky strategies for amateur investors. Beginning investors wipe out on sector funds so often because usually what happens is that you see a sector becoming hot, you see that everybody's talking about semiconductors or defense stocks or whatever, and you jump in when the price has already shot up to the sky and you are buying expensively. Now, sometimes it might still keep climbing, you might make a profit, but in many cases you jump in too late and it's just a bad choice. If your broad index ETFs are in the red and you'll need the money within 5 years, what's the best strategy right now? Should you keep dollar cost averaging into those same ETFs and hope for a bull market? Or should you sell some at a loss and move the money into something else like money market funds or other ETFs? Ideally, you don't want to be in this market timing situation where you have to look at what's happening in the market and then try to figure something out. You need to have a plan ahead of time. So if you know that you will need the money in 5 years, well, hopefully you would have known that a few years ago, and you could have prepared a plan for gradually reducing the risk level in your portfolio. So as the time comes when you need the money, you're not 100% in stocks and these swings don't affect you as much. But once you're in the middle of the crisis, once stocks start dipping, it's not really a good idea to try and time it and figure out the right moment to buy or sell. And by the way, this question was submitted during the Trump tariff dip in early April when the market dropped. Everybody was freaking out. Everybody was asking, okay, should I sell? Some people sold. And then by the time we're recording this, the dip is over. The market is back up. People who stayed calm, they did great. people who freaked out and sold, well, they kind of locked in losses. Of course, next time it could be different. That's the thing about stock investing. Past performance doesn't guarantee the future will be the same. Investing does always involve risk, and that's why you need a good long-term plan that reduces risk as the time to spend your money gets closer. For an EU citizen, is there a legal way to minimize taxes on dividends or gains from selling stocks or ETFs? Okay, so taxes are very much country-specific, but the good news is that in virtually all European countries, there are ways to optimize your portfolio so you end up paying less in tax. And trust me, I know I've done the research on 34 European countries together with professional tax researchers. There's lots and lots of opportunities depending on your country. There are some universal principles. In most European countries, you can use accumulating funds, and it's better for taxes. Not true everywhere. It's not true in Austria and Switzerland and Denmark and the UK. But in most countries, it is true. And then beyond that, you have to really look at the country-specific details. And by the way, if you're interested, we do have a training on this. It's part of our Index Masterclass training for beginning investors in Europe. And you can find out more in the link that's in the description. When buying individual stocks, how do you spot opportunities? What are your entry and exit rules? Thanks. Well, as a rule, I don't buy individual stocks, and when I have, it's been either stocks of companies where I worked and was in management so I could influence them and I had good confidence in our future results, or it was just like a passion buy where I loved the stock, loved the company, and I just wanted to be part of the story. If you want to pick stocks seriously, then you basically need very thorough financial training. You need to be able to read the financial statements, model them in Excel, analyze the stock price, do all these things. And even most professionals fail at this. It's extremely difficult. It's simply a waste of time for beginning investors to try this, or for me to even try to give you tips and pointers, because they will be useless. What is the difference between an ETF and an index fund? What are the pros and cons, and why should someone choose one over the other? I usually talk about index funds and ETFs like Apple and Android. There's a different form factor, the user experience is different, but you get virtually the same identical result. Okay, index funds came first. They are more like traditional mutual funds where you go to the fund directly, you give the fund your money, and the fund gives you some fund units. Okay, ETFs are traded on a stock exchange. They are exchange-traded funds. So instead of buying fund units from the fund, you buy fund units from another investor on the stock market, okay? But there's a lot of technical differences. At the end of the day, you get virtually the same result. In some countries, there can be tax nuances. For example, in Spain, index mutual funds have some favorable tax treatment, which can make them more attractive than ETFs. But in most of Europe, ETFs are a lot more available, and I personally primarily invest in ETFs. With current global uncertainty, is being 100% in stocks still a solid long-term strategy? I'm hesitant to start panic buying assets like gold or Bitcoin as a hedge, even though that advice is becoming more common online. Okay, so if you look at market research, actually the smartest strategy out there from a purely financial sense would be to be 100% in stocks all your life. Despite the world wars we've had, despite all the major calamities of the past 100 years, if you invested in a diversified global stock portfolio and you just stayed invested and didn't get afraid, didn't sell your investments, didn't make mistakes, you just kept investing, you would have done fantastically well, much better than if you chose other asset classes, okay? Now, the real challenge with this approach has been the ability to stay calm when things get difficult. And that's when people start making all these mistakes. And this is something you kind of learn with experience. You can learn from others, but then when you go through it, I remember how terrified I was in the financial crisis 15 years ago in 2009. I was a young banker on Wall Street, and it felt like the whole world was collapsing. Then, of course, I remember the COVID crash and how scary that was, and the 2022 inflation scare and everything. With time, you get experience. You get used to this cycle of things being scary and everything is collapsing and everything is bad. And you'll learn to just deal with it and stay invested. And if you do that, then being 100% in stocks can be fantastic. Now, some investors do use a bit of gold as part of their portfolio to reduce the overall price swings. The classic hedge for the stock market really would be bonds. even though from a long-term perspective, bonds are also a lot less profitable than stocks, so it really affects your results. But when it comes to using crypto to hedge, well, that's at first, okay? I wouldn't call crypto a hedge for stock investing. Now, crypto could be a bet. It's your YOLO. Maybe it goes to the moon. Maybe it makes you rich. I'm not a crypto person. I would talk to somebody else. But I have no rational reason to think that crypto would be a good hedge or risk reducer for my stock investments. What do you think about investing in specific stocks like AMD or Nvidia that seem to be going down in price lately, especially over a longer period? So I'm not a big fan of investing in individual stocks. Of course, when you look at something like Nvidia and the past results over the past few decades, they are amazing. They can make you feel some real FOMO, fear of missing out. You can daydream, oh, what if I'd put $5,000 in Nvidia 20 years ago? I'd be a millionaire now. Well, sure, but you didn't. And today the price is already extremely high. Now, of course, we can draw scenarios where going forward, Nvidia might do fantastically. It's also easy to draw scenarios where Nvidia will do great as a company, but not quite as great as investors expected, so the stock will go down. All right, so there's no easy way to guess if a single stock is going to outperform going forward. That's why I prefer investing in a diversified way. Which EU countries are more investor-friendly? Well, as a general rule, if you look to the east, you'll find better conditions for investors. If you look at Slovakia, Slovenia, Croatia, the Czech Republic, you can find really low taxes for investors, or in many cases, you can even invest with zero tax on your ETFs. The same is also true for Greece, for example. That said, there are also countries in Western Europe that have low investment taxes. For example, in the UK, you have ISA accounts, which allow you to invest up to £20,000 every year tax-free, and that can be fantastic. Wherever you live in Europe, though, don't let high taxes stop you from investing. It's virtually always better to invest and have a profit and pay tax than not invest and have no profits and pay no tax. I currently invest through a Swiss-based investment bank, your former employer, that offers excellent service. Would it make sense to open an additional portfolio with the broker you recommend, or even switch completely? What would be the advantage? Okay, so I still have some nostalgia for UBS, and I do think a lot of smart and capable people work there, and they can offer excellent service. The question you should really be asking is, what are the fees that you are paying to get this service, and does the service justify the level of fees? So I don't know your situation, I don't know the type of account, I don't know what you're paying, so this is only a determination that you can make. Now, does it make sense to also have another brokerage account? I personally like to have multiple accounts for a bit of diversification if any holdups, any issues happen with one of the accounts. So even if you stay with UBS as one of your accounts, it can still make sense to have another account at a different brokerage. What percentage of your net worth or investment funds should be kept in cash, ready to take advantage of investment opportunities like buying the dip? Well, in my view, aside from your safety cushion, which is there for emergencies, basically zero. If you look at the real evidence for best long-term strategies, timing the market and keeping cash aside for these opportunities, it's a losing strategy. You are almost always better off just invest as soon as possible and keep investing, and keep most of your cash invested somewhere instead of waiting for the perfect moment. I've got a good friend from Wall Street who is now quite a senior figure there, who got scarred by the financial crisis when both of us were young bankers. And he pulled his money from the market, and then he spent like 15 years sitting on the sidelines and waiting for the perfect moment to deploy his capital and use the opportunity to make a lot of money. He was expecting another huge crash like we had back in 2008, 2009, and it never came, and he just missed so many opportunities to build his wealth. So it's just one example from my personal life where I've seen that keeping cash aside to wait for the dip is not that smart. You just start investing, you keep investing, and think long term. In your opinion, what are the best energy stocks? So I don't do stock picking. I don't buy individual stocks because it's really a loser's game unless you're a professional investor who's going to spend all your life analyzing stocks and picking the best ones. And I also don't do sector investing, like, for example, focusing on the energy sector with my portfolio. This is something that really appeals to people, especially to beginning investors. They hear about some trend like AI or biotechnologies or energy or something else, and they think, okay, this is the big thing, I'm going to jump into this sector. But usually they hear about the trend too late and they jump in when prices are high and they get a bad result. When you look at the results of individual investors who do sector investing, it's actually one of the worst performing categories of investors, okay? They do much worse than the market on average because they just time it wrong and they jump into the wrong sectors at the wrong time. Do you know of any investments that can match the performance of real estate? In Hungary, nothing seems to keep up with rising property prices. I've tried the stock market, but the returns don't compare. So this question often comes from people who live in an area or a country which has experienced very strong real estate price growth. That is not true of all areas and all times. So you shouldn't expect that this will keep going the same in the future. That's not guaranteed at all, especially when we look at demographic trends that we have here in Europe. Looking broadly at many different markets, over the long term, real estate prices have usually gone up with inflation, maybe inflation plus 1% per year, something like that, okay? So the rise in prices long term really hasn't been that dramatic, and to get good returns from real estate investing, you also had to rent it out. And when you combine price increases plus rental income, long-term real estate returns have been quite similar to long-term stock market returns. So, of course, if you happen to pick the real estate market which goes through the roof, you'll get lucky. But, of course, if you pick the right stock sector or right stock, you can also go to the moon. But on average, you get kind of similar results. Now, it is true that if you invest in real estate with leverage on borrowed money, you can make more money faster than by investing in stocks. But it's not comparing apples to apples. It's apples and oranges. You could also invest in stocks on borrowed money and make more, but you are also taking on more risk. And with real estate, this can become really painful when there's a market crash and people lose their properties. They have to walk away from their mortgages. Real estate investing can be quite a lot more risky and quite a lot more time intensive and difficult than most people imagine before they buy their first property. How do I start investing in Denmark where the taxes are crazy? Okay, so I get this question a lot from Denmark and Ireland and the Netherlands where you have relatively high taxes. And fortunately, in pretty much every case, there are some good solutions. In Denmark, for example, people use so-called ASK accounts, ASK, which give you a lower tax rate. Okay, so you can invest through these accounts in foreign ETFs, and that can be a good way to get started. And other countries have their own tips and tricks as well. Is it most advantageous to invest as an individual person or through a company? Okay, so there are actually three different scenarios to consider here. One scenario is you simply open a brokerage account as an individual. The second scenario is that you have an existing business which is making money selling goods or services, and then you invest through that business. And the third scenario is you set up a specific company just for your investments. And these are completely different. If you have an existing business, in many cases, it can make sense to invest through that business because it means you can invest money without taking it out. You can offset investment income against other losses in the business. It can be beneficial from a tax perspective, but it also has some downsides. For example, if your business has creditors, if you owe people money or if you owe the government money, then your investments can be at risk, okay? So this is something you have to analyze with your accountant and lawyer. Now, setting up a separate company just for making investments can be of interest in some countries. It is a very popular move in Latvia, where I live, and in Estonia as well, because of some specific tax rules here in our part of the world. In other countries, such as the Netherlands, it can also be interesting for certain high-income individuals. But in all such cases, you should talk to a tax advisor, because this gets quite tricky. The biggest problem with investing through a separate company is that you will often have to pay tax at the company level and then at your individual level when you take out dividends. So you have to analyze this, the pros and the cons. In most European countries, having this separate company doesn't really make sense, but in some cases, it could be advantageous. You emphasize your program is for European investors, but not for US expats living in Europe. What makes that so? Okay, so I assume the question is about the Index Masterclass, which is the training program I run for beginning investors in Europe. And the answer is quite simple. I teach index and ETF investing, and when it comes to index funds and ETFs, US expats in Europe are kind of screwed, okay? Now, there's a US tax rule which makes it a really bad idea for US expats to buy so-called Europe domiciled ETFs and index funds. So these are the ETFs and index funds we have available here in Europe. That's what I teach in the program. And if you buy them, your US taxes become really, really bad. But because of European regulations, if you live in the EU or the UK, you as a US expat can't buy American ETFs like SPY or VOO. Okay? So it's kind of a catch-22 where you can't buy the ETFs available to Europeans because of US laws, and you can't buy the ETFs available to Americans because of European laws. Now, there are some ways around it, and I have thought about launching a separate training program for US expats in Europe. I might still do it one day, but our existing training doesn't really cover this. I'm a US citizen living in Spain, and I'm a Spanish tax resident. I'm paid in euros. Can I buy European stocks through an EU broker? So many European brokerages simply will not open you an account, but some others might. For example, Interactive Brokers in Ireland, because it's a subsidiary of a US company. And once you have your brokerage account, there's no problem buying European stocks or American stocks or any kind of stocks. The challenge is if you want to buy investment funds, so ETFs or index funds or mutual funds, that becomes difficult. How to protect your investments from currency risks when living in Europe, especially seeing the issues with the US dollar, okay, and the many ETFs traded in dollars. From a long-term perspective, if you're investing in the stock market, most experts consider currency risk to be kind of a non-issue because over the really long term, it kind of tends to even out. So for example, if you look at the euro-dollar exchange rate over the 26 years from 1999 to today, it went up, it went down, and it's basically in the same place where it started 26 years ago. Okay, so for a long-term stock investor, it didn't make a huge difference. But in between, there were periods when it affected your portfolio in a very positive way or in a very negative way. And those periods can be uncomfortable, okay? If you want to avoid that, you can use what are called currency hedged ETFs. So for example, here on Just ETF, if I go down to currency hedge, I can select Euro hedged ETFs, and then I will see a bunch of ETFs which remove the currency risk between the euro and the dollar. For example, here's an iShares S&P 500 Euro hedged ETF. So the idea with this fund is if the S&P 500 goes up in dollars 10%, it should also go up in euros 10%, okay? Now, it's not as simple as that. You pay extra fees for this and you get what is called the hedge return. This is an extra source of return from hedged funds, which is a little difficult for beginners to understand. But basically, if interest rates in America are higher than in Europe, as they are today, then you will be paying extra to remove currency risk. So there are complications, but if you want to remove the currency risk, it can be done. Most experts would say for long-term stock investing, don't bother. But if you're investing in global bonds, that's when you want to hedge your currency risk. At 55, is investing all of my savings, excluding my emergency fund, in MSCI World ETFs the wisest strategy? I will retire in 12 years. Okay, so I can't give individual advice to you, but I can comment generally about investors who are 55 with maybe 12 years to retirement. From a purely financial perspective, having 100% in developed world stocks can be smart, at least on paper, okay? So there is some research that suggests if you can stay calm, if you can stay invested and not freak out when the market drops, putting 100% in stocks in a diversified portfolio with low costs is basically the best possible strategy that you can have. But this can kind of crash in reality when you consider investor psychology, okay? So imagine that you've got 100,000 euros invested in the market, and then we have a big crash like in 2008, and you open your brokerage account and suddenly you see 55,000 euros instead of 100. How would you feel? Would you be able to stay calm and not make mistakes and not sell your investments at the bottom? Or would you be freaking out and so stressed out and really unhappy, and would you start making mistakes? Many people find that when the market actually goes down in a big way and it stays down for not just a few days, but for months or even a year or two, they find it so difficult to stay the course, to keep investing according to their original strategy. And that's why most experts will say, as retirement gets closer, you want to reduce the risk level in your portfolio. Okay, so what that would mean is instead of going 100% in stocks, you would start adding a bond ETF element to your portfolio. Okay, the traditional advice would be that by the time you retire, you want to be maybe 60-40 in stocks versus bonds, or 50-50, or 40-60. Some people might be a little more aggressive than that, some people a little more conservative, but that's kind of what most people would recommend. Some providers offer AI-managed portfolios and robo-advisors. What is your take on them? Well, most robo-advisors don't actually use AI for investing. Okay, so an AI investor would use some kind of machine learning to find the best stocks or ETFs and the best times to buy and sell them. Usually that's not what's happening with a robo-advisor. Instead, they just have a simple set of rules that they use to spread your money among many different ETFs and then to balance your portfolio over time. Basically, a robo-advisor automates the same principles that a smart long-term investor would do on their own. So this means that robo-advisors will typically get you better results than the typical expensive investment funds sold to you by your local bank, but they do come with extra fees, and you can usually get a better result investing on your own. Plus, if you invest on your own, you also understand what you're doing, which is a significant advantage. Are fixed deposits better than ETFs during a global recession? So if you knew for sure or with a high probability that the market was going to drop going forward, of course, you could just put your money into a fixed deposit and that would be safer. But the problem is, just because the economy shows some signs of trouble doesn't mean that the market is going to drop. In fact, by the time that everybody knows there's a recession, the market usually will already have dropped, okay? And then from that point forward, it might go up. Or, of course, if things get worse, it can drop even more. But that's very difficult to predict at the time. And statistically, if you're thinking about long-term investing and growing your wealth, you will be much better off if you invest in the stock market than if you try to put your money into fixed deposits every time the economy gets a bit shaky. Sometimes you might get lucky and avoid some market drops, but most of the time you will simply miss the opportunity to make money as the market goes up. I saw your video about tax-free investment countries. Is it possible to invest in ETFs in any of those countries to take advantage of the 0% tax while living and being a resident taxpayer in a different EU country? No, that is not possible. Where you pay tax depends on where you are a tax resident. So if I say that in Greece you can invest in ETFs tax-free, that assumes that you are a Greek tax resident. If you are a German tax resident, you cannot take advantage of this Greek 0% tax in any shape or form. I have invested in MSCI World, so that's EUNL ETF with a total expense ratio of 0.2% for the past 8 years. I discovered the SPPW ETF, which tracks the same index but with a lower total expense ratio, and I'm considering keeping my current assets in the old ETF for retirement, but switching my monthly savings plan to the new ETF with the lower costs. Thoughts? Okay, so that sounds like quite a smart way to deal with discovering a lower cost ETF. So when you discover a cheaper alternative to a fund in your portfolio, you're faced with a dilemma. Because on the one hand, you seem to be overpaying, but on the other hand, if you sell your existing investments, you may have to pay tax on any accumulated profits. So in many cases, it makes sense to leave existing investments be and then make future investments in the new ETF. And of course, I'm saying this without making any recommendation about these particular ETFs in your case. Hey Tom, I'm Portuguese and I live in Portugal. I invest in distributing ETFs domiciled in Ireland. Do I pay taxes on dividends there or only in my country? So Ireland is great for ETFs because if there's an ETF legally established in Ireland, well, Ireland is not going to tax dividends paid to investors living in other countries like Portugal, okay? Now, there is a nuance. If this is, for example, a US stock ETF, then you might be paying some dividend tax to the US at the level of the fund, okay? So let's say Coca-Cola pays a dividend to this ETF in Ireland. Well, 15% of that will get withheld for the US government. Then the money gets to Ireland, to the ETF, and then the money gets paid out to you in Portugal, and then you have to pay your local taxes in Portugal. My wife has a green card, I assume a US green card, but she works and lives in Europe. Is it okay for her to invest in ETFs here in Europe? In such cases, it's always better to talk to a US expat tax advisor. My understanding is if you're a green card holder, if you're a US tax resident, then you kind of have a problem with using these Europe-based ETFs because it really messes up your American taxes. When is an emerging markets ETF investment a good idea? Okay, so Emerging markets seem attractive to a lot of people because these are young, hungry economies which are growing fast, like Brazil or India or China or others. And there have been periods in time when emerging markets have been tremendously profitable. For example, the first decade of this century, emerging markets outperformed other markets by a lot. Doesn't matter in terms of taxes or any other way if you buy the same ETF on different stock exchanges. For example, Frankfurt, the London Stock Exchange, or the Amsterdam Stock Exchange. So in most cases, from a tax perspective, it doesn't matter, but there are some countries in Europe where there are exceptions written in law, such as if you buy an ETF on a certain kind of European stock exchange, you get tax benefits. So if that's the case in your country, you want to pay attention, but in most countries, it's not the case. Otherwise, when comparing the same ETF on different stock exchanges, I usually look at how big the bid-ask spread is and how much volume there is, how much this ETF gets traded every day, and I try to choose a stock exchange where there's more activity and I can get better prices. Is tax paid on money from a distributing ETF that is reinvested? Okay, so if a distributing ETF pays you money in your brokerage account and then you reinvest it, then yes, in most European countries, you will have to pay tax on those distributions, on those dividends, even though you kept them in the account, even though you reinvested them. Now, of course, you have to check your local country, but in most cases, you do have to pay taxes if the money left the ETF and ended up in your account at some point. What do you think about SMH, a semiconductor ETF, as 30% of the portfolio? So this is another example of sector investing, and sector investing is notoriously risky. So over the past few years, as the AI revolution has gotten into swing, semiconductor stocks have gone up in price a lot, and a lot of people hear about this, so they want to jump in. And then the real question is, are you still early? Is it still going to go to the moon even more, or are you late? And there's a big risk that you could be too late, and the future prospects of this industry are already baked into the current stock prices, okay? And so that means we can also see big drops in price. Now, I'm not recommending against it. I'm certainly not excluding semiconductor stocks from my portfolio, but putting a big bet on this should be recognized as a bet, okay? And it's quite risky. Does it make sense to invest in the S&P 500 when they say that China's economy will surpass that of the USA? Now, it does always bother me that people here in Europe assume investing means just buying the S&P 500, okay? Obviously, it can make sense to have a more diversified portfolio which invests in different parts of the world. Now, I wouldn't jump from that to immediately conclude that, okay, let's put everything into China or India because these countries will be growing the fastest. First of all, they have their own problems. For example, China has a huge demographic issue coming up. Second, there are political issues where basically there's one person at the head of the Communist Party in China who can completely disrupt foreign investment at any moment. And third, the bright future for Chinese stocks is already reflected in their stock prices, okay? It's one of the principles beginning investors don't understand about investing. If a company or a region or a country is very attractive, if there is great potential for future profits, stock prices go up, and you can't jump in and easily make an easy profit. So for most investors, it doesn't make much sense to try and guess which market will do the best. It actually makes more sense to invest in a diversified global portfolio. And then if China does well, you do well. If America does well, you do well. And you are protected from one market, one country, one political system blowing up. I realize that if you're new to investing, going through a long list of questions like this can be overwhelming. That's why I put together a simple step-by-step training for beginning investors in Europe. It's called the Index Masterclass, and you can find out more by following the first link in the description.